Good afternoon and welcome to the dissects Asian Midday Market Watch. I'm Samantha Voon, and let's start by taking a look at the summary of market actions. Brian, over to you.
Now we start with the US, and overnight the S&P 500 and the Nasdaq Composite each rose by 1.02 and 1.18 respectively. Now these increases pushed the S&P 500 above 5,600 points for the first time, achieving its 37th record high in 2024. Now meanwhile, the Nasdaq recorded its 27th all-time high for the year. The Dow Jones Industrial Average also experienced a gain of 1.09%. Now, chip shares emerged as top performers during the US trading session. The US-listed stocks of TSMC, or Taiwan Semiconductor Manufacturing Company, surged by 3.5%, following better than expected revenue from April to June. Now, competitor Qualcomm experienced a more modest uptick of 0.8%, alongside Broadcom, which saw a rise of approximately 0.7%. Now, NVIDIA, the darling of the sector in artificial intelligence, advanced by 2.7%. Now, these gains were also driven by optimistic expectations of a potential interest rate cuts. Dow Jones forecast suggested that the June year-on-year inflation rate could stand at 3.1%. Now, that's a decrease from 3.3 noted in May. Now, as for core inflation, now excluding the more volatile food and energy prices, a 3.4% is anticipated compared to the same period last year. Now, in May, the Consumer Price Index showed a 3.3% annual increase. Now, across the Asia-Pacific region, we've got Australia's S&P 500, S&P ASX 200 increasing by 0.93%. Hong Kong surged by 1.41%. Now, the futures in Nifty 500 indicated a positive start, signaling a recovery from recent losses. The Nifty has been reaching new record levels in June and early July, but has experienced some profit taking in the last few sessions. Now, over in Singapore, the STI is currently up 0.42%, and in Malaysia, the KLSC is up 0.39%. Now, over in China, the Chinese Shanghai CSI 300 and composite indexes have increased by 1.1 and 0.7 correspondingly. These gains have partly driven by a resurgence of tech stocks bouncing back from the lowest points in the 4 months earlier in July. The Chinese stock market also faced challenges due to a series of mediocre economic indicators, causing worries about a slow economic revival in the nation. Attention is currently on upcoming trade data scheduled for release tomorrow, offering further insights into the performance of Asia's largest economy. Now, regional tech shares also stood out as top performers during the day, particularly TSMC. Now, over in New Zealand, the Kiwi is the worst intraday performer among major currencies as it slumped to a 4-week low against the US dollar. Now, a dovish tilt on the latest Reserve Bank of New Zealand monetary policy statement has triggered a narrowing of the yield discount between the 2-year Australian and New Zealand government bonds. Now, Sam, over to you on Japan and Korea.
Thanks, Brian. I just want to write on what you pointed out earlier about TSMC. So the surge in chip-making stocks linked to TSMC has also lifted other Asian technology stocks. And we have the tech-focused KOSPI and also the Hang Seng indexes increased by 1.5% and 0.8% respectively. We also see SK Hynix, a memory chip manufacturer, which we mentioned 2-3 days ago. They are who is also closely related to the AI sector. They have also experienced a surge of over 3%. But of course, undeniably, we also have to mention that the South Korean stocks were also influenced slightly by the Bank of Korea's decision to maintain interest rate at 3.5% for the 12th consecutive month. But overall, South Korean KOSPI rose by 0.75%, while the KOSDAQ increased by 0.11%. Over in China, we have the Nikkei 225 surpassed the 42,000 points, 42,000 points for the first time, with other Asia Pacific markets showing gains today. So of course, the surge followed a positive trend in the US big tech stocks due to optimism surrounding the potential Fed rate reduction, as you've already mentioned earlier in the show, Brian. So we see the Nikkei rose by 0.97%, mainly driven by the tech sector, while the broader Topix index increased by 0.7%, hitting also a new all-time high. In the year-to-year comparison, Japan observed a 10.8% uptick in its core machinery orders, surpassing the 7.2% growth anticipated by Reuters. However, the decline in the core machinery orders for the second consecutive month on a monthly basis are dropping by 3.2% as opposed to the 0.8% growth predicted by Reuters, has also affected the views over in Japan. So I just want to point out here that these numbers are key indicators because machinery orders serve as a volatile yet influential measure of the capital investment in Japan. So a decline on these orders might signal an unstable economy and potentially complicating the Bank of Japan's effort to normalize monetary policies. Meanwhile, we see Toyota, the Japanese automaker, experience a positive impact in India after the Uttar Pradesh waived certain taxes on hybrid vehicles, resulting in a 10% price of reduction, according to Reuters. So that's all I have for today's market updates. Brian, over to you.
Now, thanks, Sam. Now, to bring an expert lens to today's market information, we have our regular guest, David Kuo, founder of the Smart Investor. David, it's always great to have you on the show.
Thank you, Brad. Who is this expert that you're having on?
Well, I've got to ask this expert, about the US inflation numbers that are going to be coming out this week and all the, later today, actually, and what the expectations are of a rate cut, because everyone's looking and rubbing their hands in glee saying, we're going to have a rate cut soon. What are your thoughts, David?
I tell you what, Brian, I think Jerome Powell, the Fed chair, has perfected the art of speaking out of both sides of his mouth at the same time, right? I mean, if you listen to his testimony, you came away and you took away whatever you wanted from what he had to say. So on the one hand, he said that if interest rates remain high for longer, then that could actually be damaging to the US economy. So people would say, well, who wants to damage the US economy? So it is quite likely that he will cut. Then on the other hand, he said that he is unlikely to cut until he sees a downward trend in the inflation rate. And he said there are signs that inflation is coming down, but it is still above their 2% target. Having said that, also, he said that he doesn't actually want inflation to come down to 2%. He just wants to see it coming down towards 2%. So when you listen to what he had to say, the chances are that I think interest rates are going to be coming down fairly soon. But he also said that he isn't driven by politics. And so if he wants to cut, he will cut. And he doesn't care too much about the presidential election. Going back to your question, is inflation going to be lower? I think there is a good chance that it is going to be lower, Brian, because if you have a look at the interest rate at the moment, it's about 5%. Inflation is running about 3%. I think that if we have another set of good numbers with a 3 handle, followed by something like a 0.1, or maybe a 0.0, then maybe I think Jerome Powell and the Fed chair and the Federal Rate Setting Committee could very well reduce interest rates in September. But I'm not banking on it, but I think it could happen.
For David, if that happens, then that's going to give a huge boost, whether he likes it or not, to the politics of the day, because that's going to give a huge boost to the Democrats and Joe Biden or whoever is running in November against Donald Trump.
Well, it's not just a boost for them. I think it's going to be a boost for the market. If you have a look at the stock markets, I mean, Samantha's already said, I mean, stock markets everywhere seem to be, a sea of green on the expectation that there could be an interest rate cut sometime before the end of this year. And people are piling into shares at the moment, sending markets, not just in America, but in various parts of the world, upwards. And if we do get that cut, then I think it could be followed by more cuts. And that, I think, is the expectation of the market, Ryan.
David, I want to turn our focus over to China for a bit. So China has banned short selling of stocks. What are they trying to achieve from there, David?
Well, I think we have to have a look at the calendar. We've got the third plenum coming up next week. And I mean, this is going to be a key event for China when it comes out and sort of lays out its plans on what it hopes to do, what it hopes to achieve. But it is kind of difficult to do that when you see the stock market slumping day by day. I mean, over $1 trillion has actually sort of been wiped off Chinese shares at the moment. And that is not a very good optic as far as the Chinese Communist Party is concerned. So what they're saying is, let's try and stop this short selling at the moment, stop people from borrowing shares, selling them into the market, and hoping to buy them back when the stocks are a bit cheaper, and then returning the shares that you borrow. So they've done things like increase the amount of margin that you need. So if you borrow $100 worth or 100 yuan worth of shares, you have to put 100 yuan as a margin. And this is deterring people from shorting the shares. But my take on this is this. The market is merely sort of telling you what it thinks is going to be happening to the Chinese economy. That is the way the market works. It's a forward indicator of what they think is going to happen. And the market is telling, or the investors are telling the Chinese government that you have got some structural problems there. So don't ignore the structural problems and blame us, the short sellers, for what we think is going to be happening in the market. So, I mean, the structural problems in China are very obvious. The housing market. We all know that they have a housing crisis. The US-American tensions over trade. Sort that out, right? And then finally, consumer confidence. Consumers are not feeling confident at the moment. I know, Brian, you like to look at economic numbers, whereas I, on the other hand, tend to look at company reports and they telling me what is happening. Starbucks is a classic example. Starbucks is saying that fewer Chinese consumers are going into their coffee shops to drink coffee. And instead, they're going to Luckin, the Chinese upstart coffee shop chain, which sells coffee at a third of the price. That tells me that the Chinese consumers, even the young Chinese consumers who are very aspirational, just don't have the money anymore. And things like going out and buying iPhones, they don't have the money anymore. And later on today, we will be getting results from third quarter results from Fast Retailing, which owns Uniqlo. And I think they will tell us, what the Chinese consumers are thinking, how they're behaving at the moment, and are they going into Uniqlo stores to go and buy the goods, or are they even avoiding Uniqlo, which I think is reasonably well priced goods for people to buy, and going to buy something a lot cheaper. So I think China has a problem, and addressing the shorting of the market isn't really going to help. It might give a short-term fillip, but I don't think the structural problems are going to go away just because you try and stop the short sellers from selling short in the market.
Mm-hmm. Okay, so David, another thing, we see the Japanese Nikkei hit all-time high, another all-time high, but they are not the only stock markets to reach for the skies. So what should investors do at the moment?
I don't know. I think you should ask that expert that's coming on a bit later on. What they say.
David, before you answer that, one of the key things is, and sagely advice from someone like you, and some sagely advice that I just heard a couple of hours ago from Jim Rogers.
Okay.
And he's based in Singapore, right? He's American. He's a long-term investor. And one of the key things he said, he said, I think he said something that alluded to the fact that this can only end in tears. And history is a very good lesson. And I remember you in our private discussions, and as well as our previous shows last year and the year before, You've mentioned the fact that the can is being kicked further down the road, but I think we're coming to the end of it, aren't we?
Well, okay. If you have a look at the stock markets around the world, Nasdaq, Dow, S&P 500, even the UK hitting 8,000 points and going above 8,000 points now. Malaysia, Singapore shares are about, what, 3-year high at the moment, but the Nikkei at 42,000, going above 42,000. Look, 42,000 is just a number. It's just a number. Whether it is 41,999 or 42,001, it is still only a number. What really matters is it expensive? And when you have a look at the stock markets around the world, you would say it's not really that expensive. I mean, American shares are on 25 times earnings. Over here in Singapore, we're probably around sort of 13 times earnings, which means that you're paying $13 for every dollar of profit that Singapore companies are making. Malaysia is not that expensive either. So when you look at that, you would say it's not that expensive. But Jim is right. I mean, I know Jim Rogers, and what Jim is saying is that stock markets are a risk asset, and people need to appreciate that it is risk. You can say it's not expensive, but at the same time, if you have a look at, say, bond yields, I mean, you can get 5% over in the US. And you would say, if I'm not a risk-taking person, would I be happy with a 5% return annual on the money that I have? And if you say the answer is yes, then if you've done well in the stock market, and a lot of people have done well in the stock market, then you might be tempted to say, let's take some of this money off the table now, right? And then let's just rebalance our portfolio. And it really depends on what stage of investing you are. Jim is about the same age as me, right? I mean, we're well over 60 years of age. And so our lifespan is limited. We're not like a 20-year-old where you have another 50 or 60 years ahead of you. I mean, we don't have that much time left. And so I'm not saying, I'm going to kick the bucket tomorrow, but what I'm saying is if there was some kind of disaster in the stock market, I don't have that much time to recover. Samantha has, I don't. And so therefore we look at it from different lenses. Samantha will say, I still have a very long time horizon in front of me. 42,000, yeah. There is a good chance that it could go well above 42,000, and maybe in 20 years' time, it could actually be 80,000. So she has that long runway. I don't. If the stock market were to correct, I may not actually have enough time to recover from that stock market correction. And I think that is what Jim is saying, that we don't really have the luxury of time. Samantha has. I'm not talking about you, Brian. I don't know how old you are, but you probably have the luxury of time. You probably have the luxury. Look at the color of your hair compared to mine. You have the luxury of time. Yeah, I don't. And so it really depends on who you are and your appetite for risk. And you might reach that stage where you say, I'm going to be retiring next year. I have amassed $1 million or $2 million, and I don't want to risk it, because I'm going to be retiring soon. So I'm going to take that money and convert it into bonds, and then I'll be able to live out the rest of my life and get a good night's sleep as a result of it, yeah, by coming out of the stock market. And okay, so I miss some of it, but do I care anymore? The answer is no.
Thank you so much, David, for your wise words.
I need a rest now, Samantha. Yeah, it's past my bedtime.
Okay, thank you so much, expert. Thanks for coming on. So this has been dissects Asian Midday Market Watch. Be sure to keep informed on the latest market updates weekdays at 1 p.m. I'm Samantha Voon.
And I'm Brian Fernandez.
And this video and podcast will be on our website, www.dissects.asia, as well as our social media platforms. We'll also be on our syndication partners' TV stations, radio stations, and website. Remember to like and subscribe. Thanks for tuning in.